Welcome back to Talk Tickers. Today, we're tearing down the latest earnings report from Banner Corporation for their fourth quarter of 2025. Let's jump right in. All right, so you look at the headlines for Banner, and honestly, you might get a little confused. They crushed it on profit, but they missed on revenue. So what gives, right? What's the real story here? Which one of these numbers actually matters? Okay, so let's kick things off with the good stuff. The bottom line. Banner absolutely delivered here, with adjusted earnings per share coming in at $1.55. Now, the street was looking for something around $1.46, so yeah, that's a pretty nice beat. That's the kind of number that makes people sit up and take notice. But, and this is a big but, here's the other side of that coin. The top line, the revenue, that came in at $167.7 million. And that, folks, was a miss. So you've got this weird situation, right? They're making more profit than expected, but they're bringing in less money overall. That's the puzzle we need to solve. Now, you'd think with a revenue miss, the stock might take a hit, right? Well, not exactly. What's super interesting is how the market reacted. The stock actually jumped over 2% in pre-market. So what does that tell you? It tells you that the serious investors, they looked right past that headline miss. They saw something else, something much more important. The question is, what? So let's get behind that beat. The real story here is all about their margins and their credit quality. This is what the market was cheering for. And this right here is the big one. It's the net interest margin, or NIM, as we call it. Basically, it's the profit they make on their loans. And look at this trend. It just keeps climbing. It expanded again this quarter, hitting 4.03%. I mean, just look at that steady climb. For a bank to be widening its profit margin in this kind of environment, that is a massive, massive win. So you're probably asking, how are they pulling this off? Well, it all comes down to their secret weapon, a fortress of a funding base. Get this, a whopping 89% of their money comes from what we call core deposits. Think of it as sticky money, checking accounts, savings accounts from loyal, everyday customers. It's stable, it's cheap, and it gives them this incredible power to keep their costs low and protect that juicy profit margin. The other half of this beautiful picture? It's their credit quality. Management didn't mince words on the call. They flat out called their loan book strong. And they backed it up. They only had to set aside a tiny $2.4 million for potential bad loans. In an economy like this one, where everyone's worried about defaults, being able to say our loans are solid, man, that is music to an investor's ears. All right, so this isn't just luck. It's all part of management's playbook, what they call their super community bank strategy. Let's break down what that really is. And look, you don't have to take my word for it. The CEO himself said it on the call. Their performance is all about, and I'm quoting here, continued execution on our super community bank strategy. It's not some crazy complex financial engineering. It's good old-fashioned banking. Build real relationships with your customers, hang on to those cheap deposits, and grow smartly. It sounds simple, right? But boy, is it working for them. So what does that strategy actually look like in practice? Well, it's these four key things. 1, grow real client relationships, not just accounts. 2, keep that core funding position rock solid. 3, have a service model that actually responds to people. And 4, the big one, just be a safe, sound, reliable bank. It's not rocket science, but it's incredibly powerful when you do it right. Okay, so that was the quarter that was. But as you know, the real fun on these calls happens in the Q&A. This is where we get to read the tea leaves for what's coming next. And the analysts definitely had some pointed questions. And it all really boiled down to 4 key things that you need to be watching for 2026. First up, loan growth. They're aiming for mid-single digits, but they've got some headwinds. Can they do it? Number 2, that awesome net interest margin. What happens to it if and when the Fed starts cutting rates? That's a huge question. 3, M&A. Management made it clear they're open for business if the right deal comes along. And finally, number 4, they're buying back their own stock, which is a pretty loud signal for management that they think their shares are cheap. Okay, so let's put it all together. It's time for the next call, our prediction for Q1 2026. All right, here's how we see the next quarter playing out. First, that net interest margin, we think it's going to stay pretty stable, but keep an eye on the Fed. If they get aggressive with rate cuts, that could put some pressure on it. As for loan growth, we're dialing it back a bit to the low single digits. Those headwinds in commercial real estate aren't going away overnight. But the most important thing,
credit quality. We expect that to stay totally stable. Management just sounds way too confident for us to think otherwise.
So you weigh the good, that fantastic profitability, against the kinda meh growth outlook. And what do you get? It's time for our official rating. And we're calling this one a market perform. Look, there's a lot to love here. The company is executing its game plan almost perfectly. That funding base is top-notch, and the credit quality is solid as a rock. But you just can't ignore the slow top-line growth and the fact that its fate is pretty tied to whatever the Fed decides to do. For now, we see it performing right in line with the rest of the market. But hold on, market perform doesn't mean boring. In fact, it leads to a really interesting trade idea. So how do you play this? You could set up a pairs trade. It sounds complicated, but it's not. You buy Banner's stock, and at the same time, you bet against a handful of their weaker competitors. The ones with shaky funding and too much sketchy commercial real estate on their books. It's basically a bet on quality. You're isolating Banner's strengths and betting that the best of breed will win out. And as always, please remember, this is not financial advice.